Welcome to the Franchise Tax Board State Income Tax and Small Business webinar presentation. This presentation focuses on the different forms of business ownership. As a new business owner, one of the first critical questions is determining which form of ownership will best meet your business needs. The legal structure for your business should be well thought out and discussed with a qualified professional. In addition, as your business grows, you will need to determine if the current form of ownership still fits your business needs or if a new form of ownership will achieve better results. There are many forms of ownership to choose from. This presentation covers the most common forms of ownership and some of their key features, tax filing requirements, estimated tax requirements, and advantages and disadvantages. Publication 1123, Forms of Ownership, covers the most common ownership types and other useful information for business owners. You will find this publication on our website at ftb.ca.gov. Select the Businesses tab and scroll down to Helpful Publications. A sole proprietorship is the simplest and most common form of business. It has no existence apart from its owner. A sole proprietorship consists of only one individual. Ownerships by more than one person creates a partnership. However, a husband and wife can be classified as a sole proprietorship. A business conducted by registered domestic partners must be classified as a partnership. A sole proprietorship is inexpensive and relatively easy to set up. The business and the owner are one. There is no separate legal entity and thus no separate legal person. A sole proprietorship is not required to register with the Secretary of State. However, depending on the type of business, there may be other requirements with federal, state, and/or local agencies. Since the business has no existence apart from the owner, there is no transfer of assets to start the business. However, you should make sure the business assets are held separate from personal assets to facilitate record-keeping requirements. The owner controls all facets of the business and is personally liable for all debts and actions of the business. A sole proprietor is not considered to be an employee of the business. Therefore, the proprietor must pay self-employment taxes on self-employment income derived from the business. The life of the business continues until the business owner dies or no longer decides to be in business. The taxable year of the business is the same as the taxable year of the owner. Most individuals are on calendar year. Therefore, income cannot be deferred by staggering the taxable year of the proprietorship and its owner. In most cases, losses incurred from the sole proprietorship may be used to offset other income. However, passive activity and at-risk rules can apply to sole proprietorships. Also, if IRS or FTB determines that the activity was not engaged in for profit, the loss may be disallowed under the hobby loss rules. It is also advisable to have a separate bank account and insurance to cover the risk of running the business. The advantages of a sole proprietorship include: it's simple and easy to establish, operate, and dissolve. In most cases, business losses can offset other income. Keep in mind, loss deductions are subject to passive activity and at-risk rules. Also, the loss can be disallowed under the hobby loss rules if the business was not engaged in for profit. The entity is not subject to taxation. The business income is taxed to the sole proprietor at his or her marginal tax rate. The marginal tax rate may be lower than the corporation's marginal tax rate on the same amount of income. The disadvantages of a sole proprietorship are that a sole proprietor is personally liable for the business's liabilities. The proprietor is taxed on the profits when they are earned, even if the profits are reinvested in the business and not distributed to the owner. And their limited capital and net income is subject to self-employment tax. The owner of a sole proprietorship reports business income and expenses on a federal Schedule C, profit or loss from business. When you complete a federal Schedule C, you must then provide a copy of your federal return, including Schedule C, with your Form 540, California Resident Income Tax Return. The return due date is normally April 15th for the calendar year taxpayers. The tax rate is based on the proprietor's total taxable income, which includes all sources of income, that is, wage income, investment income. The sole proprietor will need to pay estimated taxes quarterly unless there are no other sources of income, such as wages from an employer where they take withholding from the paycheck. Generally, estimated tax payments are required if you expect to owe at least $500, $250 if married registered domestic partner filing separately, in taxes for the current year, after subtracting withholding and credits, and you expect your withholdings and credits to be less than the smaller of 90% of the tax of your current year tax return, or the tax listed on your prior year tax return, including alternative minimum tax. Prior year exception is eliminated if your adjusted gross income, AGI, is greater than $1,500,000 if married, registered domestic partner filing separately. If there are withholdings, the sole proprietorship needs to ensure the amount is enough to cover the tax due on business income as well as wage income. Estimated tax installments are due and payable on April 15th, June 15th, September 15th of the taxable year, and January 15th of the following taxable year. To report the estimated taxes, the owner must complete Form 540ES, Estimated Tax for Individuals. See instructions for California Form 540ES, Individual Estimated Tax, for additional information and applicable rates. Now we'll talk about partnerships. A partnership involves two or more persons operating a business for profit. The business is not taxed separately, but is a conduit where the profits and losses of the partnership flow through to the partners. There are two basic types of partnerships: general partnership and a limited partnership. A general partnership involves two or more persons who agree to create a business and share the profits and losses. All of the partners share equal rights and responsibilities and assume full personal liability for the debts and obligations of the partnership. A limited partnership involves two or more persons who agree to create a business and share the profits and losses. A limited partnership has at least one general partner and at least one limited partner. The general partner manages the business affairs, while the limited partner typically provides only capital to the partnership. As in a general partnership, each general partner assumes full personal liabilities for the debts and obligations of the partnership. The limited partner's liability is limited to their investment in the business. An entity formed as a partnership may elect to be taxed as a corporation for federal and California income tax purposes. See the IRS Form 8832, Entity Classification, or IRS Form 2553, Election by a Small Business Corporation. In order to form a limited partnership in California, a partner must file a certificate of limited partnership with the California Secretary of State. A limited partnership formed in another state must also register with the California Secretary of State prior to conducting business in the state. Key features of a partnership are that it is flexible and relatively easy to set up. The partners decide the structure of the organization and the distribution of the profits and losses. A formal written partnership agreement is advisable. It's recommended that a partnership establish a separate bank account to run the business operations. A partnership allows more than one owner, unlike a sole proprietorship. The cost to form a partnership is generally less expensive than a corporation. A partnership does not pay income tax. However, a limited partnership must pay an annual tax of $800. The items of income, deduction, and credit flow down from the partnership to the individual partners through the California Schedule K1, partner's share of the income, deductions, and credits, etc. Each partner is responsible for paying taxes on their distributive share. In a general partnership, each partner is personally liable for all the business debts and lawsuits. A partnership exists as long as there are at least two partners and one of them is a general partner. Partnerships that engage in a trade or business in California or earn income from California sources must file the California Form 565, a partnership return of income. Every limited partnership registered with the Secretary of State must file Form 565, even if it has no income from California sources. A partnership provides each partner with a Schedule K1, outlining the partner's distributive share of the partnership's income, deductions, and credits. The return due date is the 15th day of the fourth month after the close of the taxable year. A limited partnership must pay an annual tax of $800. A partnership has no estimated tax requirements. However, partners may be required to pay estimated taxes for their own reporting purposes. A partnership may be required to withhold taxes if the partnership distributes California source taxable income to a non-resident partner. For more information about partnership withholding, see FTB 1017 Resident and Non-Resident Withholding Guidelines.